41. What is the difference between operating lease and capital lease accounting? Answer: operating leases are expensed over time, while capital leases are treated as asset acquisitions and result in depreciation and interest expenses. 42. How would you assess the credit risk of a company in financial modeling? Answer: credit risk can be assessed by analyzing financial ratios, credit ratings, and the company's ability to meet debt obligations. 43. Explain the concept of the Modigliani-Miller theorem. Answer: the Modigliani-Miller theorem states that in a world without taxes and bankruptcy costs, the capital structure doesn't affect the value of a firm. 44. What are the key assumptions in a DCF model, and how do you justify them? Answer: assumptions include revenue growth rates, operating margins, capital expenditures, and discount rates, which should be based on thorough analysis and research. 45. How do you calculate the terminal growth rate in a DCF model? Answer: the terminal growth rate is often assumed to be a sustainable growth rate for the company or the economy, typically in the range of 2-4. 46. What is the purpose of a cash flow waterfall in project finance modeling? Answer: a cash flow waterfall outlines the distribution of cash flows among various stakeholders, including lenders and equity investors, in a structured manner. 47. How do you handle foreign exchange rate risk in financial modeling? Answer: you can use forward contracts, options, or scenario analysis to account for the impact of currency fluctuations on cash flows and financial statements. 48. Explain the concept of a leveraged buyout elbow model. Answer: an elbow model is used to evaluate the acquisition of a company using a significant amount of debt, often to maximize returns for private equity investors. 49. How do you calculate the weighted average lease term WALT for a real estate investment? Answer: WALT is calculated as the weighted average remaining lease term for a property, considering the expiration date of each lease and its proportionate contribution to income. 50. Can you explain the concept of a waterfall structure in a private equity fund? Answer: a waterfall structure defines the order and distribution of profits among fund investors, with varying levels of priority and hurdles for different classes of investors.